Tuesday, June 13th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at the UK housing market. I think it's on the brink of some chaotic events. I'm not sure how it's going to translate into whether there's going to be people defaulting on their mortgages, whether the government and the Bank of England is going to help. But gilt yields are showing me that it's getting serious. So that's what we're going to look at. And I have covered that quite a bit in the last month or so because I've noticed that yields had been rising. They look technically bullish, which is a bad thing because when yields rise, the value of mortgages, the value of bonds drop. And people also that need to renew their mortgages, they're going to have to pay more, of course. And there's a lot of renewals coming by the end of this month and by the end of the year. It's a total of about 750,000 mortgages are coming due, deals are coming due. Before we go into that, just wanted to look at some stories that I've seen in the last 24 hours that are interesting. We've got one here from someone I follow on Twitter who's got a lot of followers, Ben Rickert. Yes, that's nom de plume for this individual. But he notes that some U.S. ports have shut down and trade is collapsing. The shutdown of ports like Seattle is being blamed on labor disputes, but that does not explain the collapse in demand for cardboard boxes, a mainstay of trade. Well, that's something I never thought of looking at, but here you go. This is from Charles Schwab, and it's Bloomberg data, cardboard box recession, industry shipments of corrugated boxes in billions of square feet year on year. So we are at levels last seen in the 08-09 crisis in terms of a percentage drop. It's even worse than 2020 during the pandemic. So keep that in mind, because the next headline is that the People's Bank of China cut the 7-day reverse repo rate for the first time in 9 months. It was a small cut, but the rate is quite low. They cut it from 2% to 1.9, so 0.1%. Well, what does that mean? Well, that means that arguably the second, not arguably, but the second or arguably the biggest really economy in the world is cutting rates and slowing down. That goes hand in hand with that box recession, doesn't it? And the other one that came out is to do with the UK. And you might look at it and think, how can the UK economy be in trouble? How can GDP still be expected to come out at minus 0.1 quarter on quarter on an annual basis tomorrow? And we have like huge numbers for employment. It came out at 250,000 for the previous 3 months. And the other thing, though, that is worrying for the Bank of England and the gilt market is the fact that wage growth accelerates to 7.6%. And so that was higher than expected. It was expected to come out around 6.1 and 6.9. So wage growth, the Bank of England is going to be concerned. They're going to say that that's inflationary. Of course, we know that that's the consequence of currency debasement. People are going to ask for higher wages. They need to, because they can't survive with what they're earning. All the costs are going up. Taxation is going up because we're not seeing the thresholds for the tax brackets being lifted up until 2028. That's just going to be another extraction of wealth from the workers in the UK. And I said that it's interesting because employment change in the past 3 months has been 250,000 employment new jobs created, and it was expected 150. So you might think, how come the economy seems to be doing well? New jobs created, wages rising. And then we have something like GDP, which is coming out tomorrow. And that's expected to drop on the 3-month basis by 0.1. But at the same time, employment went gangbusters. It doesn't make any sense at all. Maybe the employment is all in the public sector. Who knows? The other thing I wanted to talk about is that we were told, of course, by the Bank of England back in March that the taxpayer did not bail out SVB UK. Silicon Valley Bank was bought by HSBC by £1, and the government was involved, but they made sure they told us, oh no, we did not bail them out. But yesterday I saw this tweet by the Prime Minister Rishi Sunak, and he said, back in March we acted decisively to rescue Silicon Valley Bank. Rescue. So in my book, a rescue is a bailout. You just have to look at the dictionary. Go rescue synonym, and you find that it's a bailout or bailout synonym. And he says, I'm proud to be able to announce, it's just propaganda, and they're trying to play this up. And he puts a tweet from Jeremy Hunt back in March about this. He says, this morning, this is Jeremy Hunt a few months ago, this morning, the government and the Bank of England facilitated a private sale of Silicon Valley Bank to HSBC. Deposits will be protected with no taxpayer support. So my question is, what does facilitate mean? And what does deposits will be protected? Well, will be protected on the back of the taxpayer. I'm sure the government guaranteed it, or else Rishi Sunak wouldn't have said it was a rescue or a bailout. So there you go. And with that, the last piece of news I wanted to show you, and it's to do with the UK economy. So doing really well, right? The economy, great jobs growth. Well, not for Tufnells, one of the biggest moving companies, removal companies in the UK. They've gone into administration, and there's going to be 2,000 jobs lost. Of course, government is not going to bail out a removal company. I'm not saying that's a good thing or a bad thing. What I'm saying is they bail out SVB UK, which is heavily involved with all the fintech companies. They're probably helping the Bank of England design the new CBDC wallets, right? Because they're going to outsource that. Yeah, they're happy to bail them out, but not a removal company in the real economy. So there you go. With that, I wanted to talk about the gilt market because things are getting precariously serious, if that is a term. I think I just made that up. But as we speak here this morning, we've got the 2-year yield actually testing the daily high from last year in September, October time, when we had the gilt crisis, the gilt meltdown, the LDI, defined benefit pension crisis. We saw cable get down to 103 versus the dollar. So we're back there. It led to the resignation of Prime Minister Truss and her Chancellor Kwasi Kwarteng, shortest serving Prime Minister ever, 44 days. So here we are, retesting those levels. Am I saying Sunak and Hunt are going to go? Yeah, maybe. Maybe even worse. We might even get a general election. And why do I say that? A general election before next year, before the end of this year. Well, because, and I don't follow politics, but I follow the markets and I follow interest rates and the bond markets. And I worked in that market for over 20 years and I know what this means. It means big trouble for the UK. And yes, the numbers were good today, but just look at this chart. This is a 2-year gilt yield. And I said here, the scariest chart in finance, UK sovereign debt crisis imminent. So yesterday, as you can see, I drew this chart yesterday. We were at 467. And this is a weekly chart. And you can see that last year we got up to around 480. So right now, as I speak here, we're around 475. So aside from doing fundamental analysis of the economy and the system, I always looked at technical analysis as well. And some people might think technical analysis is useless, but I don't think so. And what we're seeing here is a huge move from around the end of 2021, as you can see here, from around September. And just notice how 2-year gilt yields were at 0 or even negative, which is ridiculous, of course. But we moved almost in a straight line from the end of 2021 till last year when we had the crisis. We went from negative to 480. And of course, the Bank of England stepped in. The government stepped in last year to help everything. How did they step in? Well, more guarantees, more QE, and they've been able to stop the rot, and that formed what we call a consolidation. And that little flag or pennant, that's the consolidation. And the consolidation pattern usually resolves itself 3 out of 4 times, going the same direction as the previous trend. So the previous trend was a rise from 0, let's say, or negative to 4.8. Then we had the consolidation, and now we've broken out of the triangle. And now the next, and we've broken out of the triangle quite a while ago, and that's why I've been warning about this. But the next important level here is breaking out of the high here from last year. And what would be the target? Well, it's pretty scary actually. The target, you just add the distance from the first move. You project 0 to 4.8 from the break of the triangle. So you add 4.8 to around 3.7, and that gives you a rate about 8.5% in the 2-year. And in how long? Well, I think by 2025, and I've been warning about this. I did a video probably a few weeks or a month ago saying we could see double-digit mortgage rates. And why the 2-year gilt yield? Well, because that's what they price the 2-year swaps off, and the mortgage rates are priced off the 2-year swap. So I expect more deals to be canceled by the mortgage lenders and the bankers. You will hear more headlines. Not that I know that it's coming out, but it will come out because this is pointing to it. And I just wanted to show you another chart, a weekly chart, going back to 1991 for the 2-year gilt yield. So you can see here a bigger picture. And that trend line from 1991, that was broken back in beginning of 2022. There's another one that I warned people about last year, and it was just before the crisis, and it was around 2.7 on the 10-year, because the 10-year is very important as well. So you can see it doesn't look good, and I think the 40 years that we had of declining interest rates or yields is over. And I thought that was going to happen back in 2021, 2020, that the bond bull market was over. But my only doubt was whether the unwinding of that would be really sharp and quick or protracted, more smooth. And it doesn't look like it, though. It's almost like bond prices went up, massively for 40 years, and now they're coming down the elevator shaft. That's the analogy. So this is going to be a big problem for the government, for the Treasury. I don't know how it's going to translate into in terms of crisis. I'd never heard of LDI and the fact that defined benefit pension schemes were so leveraged. And that's the other problem, all the derivatives and all the leverage. But I'm sure we're going to start hearing about some trouble in the financial system, and we might not have heard of it before. Yeah, interesting times. And of course, there could be intervention by not just the Bank of England, by the government. I think they're desperate to keep things going, of course, because they have a general election to be called by next year. And as I said, I think we could be on the cusp of a huge sovereign debt crisis for the UK. So I'm not too sure they'll be able to survive even before the end of 2023. So maybe Boris Johnson resigned because he's preparing to run again. Who knows? There you go. So with that, let's quickly look at the markets. And we're going to start with the bond market. We'll look at the gilt yields right now. So yeah, the 2 years at 4.76. So it's up 12 basis points. So it's up quite a bit. I think now that the key level is going to be 4.80. The 10-year is up 7 basis points at 4.41. But right now we need to focus on the 2-year. That's the important one. And yeah, interesting times there. For the US, we've got, the 10 years down 3 at 3.73. The 2 years at 4.55, down 3.5. Of course, we got CPI today, and we got the Fed tomorrow, a lot happening, and we could see a lot of noise and volatility in the short term for the markets. So I'm not sure I said it's 8:22 a.m. London time, by the way. We got spot gold at 1965, so that's up about $7. We're 1/3%. We're right near the highs. The low's been 1955. Silver is up 15 cents at 24.20, up 0.6%. The stock market index futures are, except for the NASDAQ, everything is pretty much unchanged. NASDAQ is up about 0.5%. The currencies are fairly strong here versus the dollar. The pound is up 0.4 at 125.64. The euro is back above 108 here, up 0.4 as well. Dollar's down slightly versus the yen, 139.50. And the dollar's up about 0.2 versus the yuan at 716. So not much of a move there after the repo rate cut, reverse repo rate cut. Aussie dollar is up 1/3 at 67.75. Dollar's down about 0.1 versus the Canadian dollar, 133.55. And the Kiwi dollar is up 0.5% at 61.50. To the commodities here, let's have a look where they are, if I can get them up. We got WTI crude up 0.75%, 67.70. Brent is up 1%, 72.50. High-grade copper is up 1.5%, 382. And platinum, that's up $3, just trading below 1,000 right now. So with that, I'm going to wish you all a very good day. Take care. Bye.